Markets are constantly changing, but here are 5 timeless investing rules that never will. Welcome to Get Started Investing, a podcast where we unpack everything that you need to know to start or improve your investing journey. My name is Bryce, and as always, I'm joined by my equity buddy, Ren. How are you?
I'm very good, Bryce. Very excited for this episode. Very excited to share these 5 timeless investing rules that we've learned over our journey that we think everyone must know. And we're not going to cover off the same old rules.
Start
We're
early.
not going to say, start early,
Start small.
the average is enough, the power of compounding. We're going to try and do things that are perhaps a little less discussed, but we think are really important and lessons that we've internalized over the years. So let's start at the top. Number 1, what have you learned?
Number 1, when it comes to building wealth, the most important thing is your savings rate.
It's counterintuitive. Everyone thinks it's about how much you can juice your returns. It's not sexy. Personal finance is nowhere near as sexy as investing, but it is the most important thing.
It is.
There's a book, The Millionaire Next Door. It was published in the 90s, and it profiled like 3,000 US millionaires and looked at their what were the common features amongst people who were actually millionaires. And it wasn't high paying jobs. It wasn't great investment returns. It was the ability to save as much as possible from what you earn and invest that.
Yeah, that's the sub lesson. Save and then invest it.
Yes.
Don't sit it in the bank account. So give us some numbers.
And you don't need to be earning a lot to start to grow meaningful wealth. So the median Australian salary, according to the Bureau of Statistics, is $65,000 a year. You put that through a tax calculator, divide it by 12. The median monthly after-tax income in Australia is $4,300. So let's say you can save 10% of your income, $430 a month that you invest. If you do that for 30 years and you earn 10% return, you'll have $850,000 after 30 years. If you can juice your savings rate, if you can save an extra $100 a month, just an extra $100 a month, you can take that $850,000 and make it $1.06 million. The highest leverage thing you can do is increase your savings rate.
Yes. Now, we did a deep dive on our savings rate on a recent episode. Just search Pocketsmith in your podcast app and you'll be able to hear how Ren and I are going with our savings. Lesson number 2, trends last longer than you think. Yes.
One of the most common questions in investing is, have I missed this?
Oh, gosh.
Often the answer is no.
It is, yeah. And it's so hard to feel that at the time, though, when things are ripping and you feel like everything's at record highs. Have I missed it? The answer is no. And this, for me, Ren, applies to, I look back on my early days in investing and the bull markets that we've gone through. And time again throughout that period, people have said, everything's too high. It's, we're coming for a correction. You've missed it. And I think I've learned that staying invested and not so much listening to that commentary, because you can miss out on incredible returns thinking that the opportunity is over.
Yeah, I think this is also just beyond like the movements in the stock market, like the changes in the economy that we're seeing, that we are living through. People often ask, have I missed the chance to invest in this? And, these changes that we're living through are multi-year, but sometimes even multi-decade changes. And the opportunity to invest in them isn't there one day and gone the next. And the classic examples, like Spotify for me was an example where I thought I had missed the opportunity because Spotify had jumped and taken so much market share. And it was like, it's already so high. But Spotify has just continued to take market share and continued to grow for years after that. Another one that comes to mind from our investing time is the transition to e-commerce. A lot of people in like the mid-2010s thought, Amazon and Shopify, the opportunity to invest in them has gone because they've already taken such market share and they're such leaders. But no, this is like a multi-decade trend that is playing out. And the opportunity is there, probably still there with some of these e-commerce companies. And on the flip side, the opportunity to get out of companies like Maya and, the old retailers that falling away. Like trends last longer than you think in both directions.
Yeah, yeah. I think an actionable thing for me with this is allocating small amounts to just get you into the trend, and then feeling comfortable that, okay, I'm in it. I've got rid of the feeling of missing it. Now let's allocate to it properly.
The trend we haven't spoken about here is crypto, but that obviously has lasted longer than we thought as well. Lesson number 3, the stock market is not predictable.
Yes, it's a moving beast. It's a complex system.
Yeah, so you could technically classify it as a complex adaptive system. And a complex adaptive system is something where there's a number of different components or agents that interact, adapt, and self-organize in response to internal and external changes. And then the system as a whole changes as a result of all those interactions. And the point of that explanation is simply that the movement of stock prices is never just a result of one thing. It's a result of interactions of millions of people responding to their own incentives, to their own stimuluses, and it's not predictable. Because even as you develop the ability to predict it, the fact that you are able to start predicting things then makes the whole system change as a result of that. So we will never get to a point where a computer model can perfectly predict the stock market, because the existence of that prediction engine will then change how people behave in the stock market as a result. And so, yeah, I think, there's some quotes here from Charlie Munger and Howard Marks, and the gist of them is really just, you can't predict it.
Yeah, which is, again, a sub-learning here. I've noticed an increase in the amount of experts that have come on the show in the last 3 or 4 years who now focus a large chunk of their research and personal learning on the psychology just psychology, understanding how humans behave outside of finance, but just understanding how humans behave, because as you said, this is all driven by human behavior. So if there's an action from this one as well, perhaps add a psychology book to your summer reading. Yeah,
so the Munger quote is, if you're dealing with a complex system, the rules of thumb that worked in the complex system in year 1 may not work in year 40. The laws of physics you can count on, but the rules of thumb in a complex civilization changes as the civilization changes. Howard Marks's quote is, markets change in validating models. Accounts of the difficulties of quant funds center on the failure of computer models and their underlying assumption. The computers that run portfolios attempt primarily to profit from patterns that held true in past markets. They can't predict changes in those patterns. They can't anticipate aberrant periods, and thus they generally overestimate the reliability of past norms. And I think if you get lost in that quote, the best example of that is Renaissance, which is a quant fund. They use computer models to try and predict the market. They've had incredible returns. They've averaged 66% a year for a couple of decades. But here's the thing. Even with all that computing power, even with all that predictive ability, they get 50.5% of their trades correct. They get it wrong 49.5% of the time.
Yeah.
And so anyone that can tell you they know how the stock market's going to go, they know how the market's going to react to news, or that they can predict what's going to happen in the short term in the stock market, they can't.
Yes. Sub-lesson 3.B is you don't always need to get it right.
Yes.
To be a successful investor.
Yes.
Ren, number 4 is professionals are playing a very different game.
Yeah, I think this is such an important one, because just the nature of financial media is that a lot of financial media is made by the industry and by professionals. And often it's professionals talking to professionals. Certainly not us, but I think it's just important to understand that there are different games that can be played in the stock market. There are different ways to make money, and people are responding to different incentives that they have. Professional investors generally are playing a shorter term game. They are playing a game where they want to maximize their career advancement. They want to maximize their bonuses. They want to maximize the inflows that they can get this year and next year from, deep pocketed institutions and the like. That is a different game to what we're playing as everyday investors who are trying to build personal wealth over the long term.
Yes. Now, I think long term is the key thing here, because one of the best examples of how this all plays out is when it comes to risk, and how they talk about and define risk and how we talk about and define risk.
Yeah.
And for us, you know, long term for us, in my mind, is decades long. Whereas for them, it's 5 to 7 years, and their risk is tied to that time frame. How they perceive risk tied to that time frame.
Yeah. Okay. Yeah. I see what you're saying. Yeah. Yeah, definitely. So I think there's two separate things there. One is long term. Like when we talk long term, we're talking like 20 or 30 years because that's the length of a working career. They're talking 7 years because that's when they need to jump ship to the next opportunity, and they need a good track record to point to.
Yes.
But yeah, you're right. Then also when we talk about risk, we're talking about different things as well, because for investors, risk is volatility. It's the share price is moving up and down because they get benchmarked every quarter, every year, every period that you can think of against the index. And so it's risky for them to underperform in any given period. And also a lot of their people they're investing on behalf of maybe rely on having that balance. And so it is riskier for them. You know, if they're retirees, they need the income from the investments. So they can't stomach volatility as much. But for us as everyday investors, risk is the risk of permanently losing your money, of that money no longer being there when we need it in the future. And so it's just, again, same word, same pursuit, investing, but different meaning. And I think we just have to understand that sometimes there's different meanings and there's different games at play. And I think a final way where it pops up is portfolio construction rules. A number of the portfolio construction rules you'll hear from professional investors, they don't need to apply as strictly for everyday investors. Everyday investors have the ability to let their winners run more and, can have different rules around portfolio weighting.
So I think the action here really is, if you are reading anything written by professionals in the media, particularly around portfolio weighting, cutting winners, specific allocations to stocks, make sure you're aware of the underlying incentives that are driving that conversation.
Yeah. And look, the way that you finish that maybe makes it sound like a little bit nefarious, but there's nothing wrong with it. It's just recognizing that it's a different game.
Yeah, absolutely. Now, number 5 is doing nothing is often the hardest thing. And this comes down to the fact that the whole investment industry is geared and designed for us to feel the need to do something.
Yes.
Trade often, read a lot, make decisions based on everything that is going around us in the world at a speed of knots. Check our brokerage every day.
I think reading a lot is... good.
Read a lot of crap, I should say. Read a lot of crap.
So I think the incentives of the financial industry are for activity. Brokers and exchanges get paid based on buying and selling activity. And you're right, financial media get paid on clicks, downloads, listens, or views. So it's just that there is an industry that wants you to do something, to engage with them in some way. Yeah. And the money is made in doing nothing. The money is made in setting your portfolio and waiting, and not, feeling like you need to act. And responding to that stimulus to do something. There's this Fidelity study, which may be apocryphal, like it may not be true. I think people have struggled to figure out. I don't think Fidelity have confirmed if it's true or not. But in the US, they looked at their best performing investment accounts, and over like a couple of decades period. And what they found was the best performing investors were dead. Because those were the only ones that weren't touching their account and just letting their money compound.
So yes, if you haven't yet read our book, Don't Stress, Just Invest, this is a good one because we take you through 4 steps to make sure that you can set up an investment strategy where you don't have to do a lot at all, but you will be sorted for the rest of your life. So good little idea for a Christmas present leading into the end of the year. So Ren, those are the 5 timeless investing lessons that we've learned over the last 8 years of the podcast. Any closing thoughts?
Well, I think you can tie some of them together pretty quickly. And I think what you start to see is that our investment philosophy, at least for our core portfolio, bleeds through. Focus on your savings rate. Invest in for the long term because trends last longer than you think. Once you're invested, don't try and predict the market because it is an impossible task. And then the best thing you can do is often nothing.
Yes.
Set it up and forget it and keep going. And as you said, we've written the book on it. So people can pick that up if they want to. But otherwise, tune in next week. Give us some more clicks, views, downloads, and listens as we keep unpacking the world of investing.
Well, we'll put a link in the show notes to the book. As I said, great gift for Christmas. We'd love to hear from you. If you have rules or lessons that you've learned, come and join us in the Facebook discussion group. Also, if you have a question, we'd love to hear it. So you can leave a voice note. There will be a link in the description or in the show notes. If you love these episodes, please, if you could take 2 minutes to leave a rating and a review on your podcast app, that would be greatly appreciated. Like the video, subscribe wherever you're watching. It does go a long way to help us get in front of a new audience. So thanks for listening as always, and Ren will pick it up next week.
Sounds good.